Hello and very good morning to all our dear students. I hope you're doing fine and doing absolutely great. Today we are on our second session, which is on the chapter corporate valuation. So just give you a reminder that earlier when this course was not updated, means it was an old course. Name was an old course. Then these two chapters were combined. So now there is a very strategic and a very good move that these chapters are separated so that you can learn those concepts which will be useful in the merger acquisition chapter. Okay, so before we basically start the session, I would just like to tell you what is important in this chapter, because I had written in the last class as well, but just in case you were not present that time. So the topics to be covered. Okay, so number one that we covered in the last class was the value of the firm. So that is the most important thing, because the chapter's name is corporate valuation. How do you value a company? How do you raise equity, either in form of IPO or FPO? What is IPO? Initial public offer. What is FPO? Further public offer, just like Yes Bank has done that. So when you value a firm, that is based on two things. One is free cash flow to the firm, okay, and free cash flow to the equity. So these are the two things which is required to be calculated in the exams, and that you should be knowing. We have done comprehensive questions in the last class. Based on that, we will be doing one more question which was left. Because of time constraint, I wanted to do it in the fresh class. And today we are also doing another important concept, which is called as the concept of the gearing of beta. Okay, pure play technique, all those things, because a lot of students I've seen face problem as far as this thing is concerned, and they try to ratify the steps. I'm not saying you guys always ratify. I've seen a lot of people, a lot of students ratifying how do we calculate beta. So I hope this will not be required anymore after today's class. Okay, and again telling you, the best way to study all these concepts is nowhere but your study material. Okay, and your past papers, mock examinations are also available on the website. I saw a few days. So I think this is really a lot of assignments that you have with you, and they are the best for your exams. Okay, and third one today that we'll be covering up today is the concept of the economic value added. So not much question, I would say, rather maybe 7 to 10 are the number of questions that we'll be covering, around 4 questions. So it's a very, very simple thing that we'll cover up. One will be examination oriented presentation that I'll show you, and one will be the conceptual clarity. Okay, basically what EVA is, that I'll tell you first, because you should also have the practical knowledge when you go to the real world. And also your aim is to clear the examination. So I will also tell you that how do you have to present in the exam. So both the things will be covered today. Okay. And so before we start, you have any doubts from the previous session, let me know. Just to give you the reminder, we have completed question number 1, question number 3, and I think 4 as well. I'll just tell you. Yeah, 4 as well. Okay. And 6. Okay. Question number 5 is very, very similar to question number 4. Okay, question number 3. So again, there was a mistake from the analyst. So how do you calculate the book values? All those things are there. So 3 and 5 are very, very similar. 5th you can do at homework, and you need the answers. I'll give you the answers. What are the answers? Okay. So today we are starting with question number 2, and it's a very good question from our Board of Studies knowledge portal. Okay, so let me just take you over there. This is the question. Okay, just 1 second. Yeah, question number 2. So I hope that will be visible to you, beta. Okay, so what is this? ABC Limited is considering a new sales strategy that will be valid for a period for the next 4 years. Okay, new sales strategy. They want to know the value of the company from the following information related to the year which has just ended is available to you. Okay, Okay, yeah, yes. So they are looking for the new strategy. The following information relating to the year which has just ended is available. Okay. Number one is the sales, gross margin, administration, selling, and distribution expense contribute about 10%. Your PBT comes about 2000. PAT tax is 30%. PAT is 1400. And you have certain extracts from the balance sheet, not the entire balance sheet. So you have fixed asset, you have current assets, you have equity, right? And if it adopts the new strategy, sales will grow at the rate of 20% per year for the next 3 years. The gross margin ratio, asset turnover ratio, and capital structure and the income tax will remain unchanged. Okay. So, beta, one tip for your examination. Okay. A lot of time I've seen the examiner testing your ratio analysis. Okay. The formulas which are there, because as I told you in the last class, there is also a concept of interest coverage ratio in your study material. Okay. Again, a very brilliantly question framed from the Board of Studies. So that gives you an edge that whether you know the interest coverage ratio or not. The question is pretty simple. I mean, it's a very straightforward question that whether the new borrowing has led to interest coverage ratio or not. Okay. So if it reduces, it's a bad thing for the company and vice versa. So they're just testing your ratio analysis formulas that whether you are aware or not. Here also the examiner is testing you with a concept of gross margin ratio and asset turnover ratio. I know a lot of students know all these ratios, but in the exam sometimes if you forget, so you will not able to proceed with the question. So when you are learning about SFM, don't think that the examiner cannot ask you anything which is related to ratio analysis. They have been testing you a lot of while, so you need to do that. Okay. Depreciation would be charged at net fixed asset at the beginning of the year. Okay. So this you have to take a good view, because this is something which is which might have to do the working. Okay. This particular line. Okay. So this one. Okay. The company's target rate of return is 15%. Determine the incremental values due to adoption of the strategy. Okay, clear? So can we start this question? So I'm assuming that you have the assignment with you. I will not like to overwrite the things on the assignment itself. Okay, I will prepare the format and the solution from here. Okay, the line that you can see right. Okay, beta. Solution. Okay, so how do we proceed further? Number one, it is asking for the incremental value of the adoption. What does basically beta incremental value means? Presentations also matters a lot in the exam. Incremental means something, what is the additional thing that you have gained or let's say earned. That is something called as incremental. So now it says, since it is coming with a new strategy, okay, so what is basically the gain or loss from that particular thing? Okay, clear? So if you can see the first figure, which is given as sales, I will be writing over here sales. Okay, and I will write for year 1, 2, 3 and 4. It's a 4-year strategy, so you have to work accordingly. Okay, beta. In the next line that you can see, it says the sales growth. Okay, the first line you can see from the screen as well. The sales will grow at the rate of 20% per year for the next 3 years. Okay, so it will keep increasing at the rate of 20%. So you can see the first figure, which is given at 20,000. So you can increase your 20,000 into 1.2. So that comes out to be 24,000. Is it clear? 20,000 into 1.20. So that will give you the figure. So I can write over here 24,000, and after that I need the calculator, honestly. Okay, so that is your sales. Okay, 24,000 into 1.2. Okay, so that comes out to be 28,800. Okay, into 1.2, 34,560. Okay, Okay, and it will grow only for 3 years, not for the 4th year. Okay, for 3 years only. 4th year it will remain same, 3, 4, 5, 6, 0. Okay, clear? Then comes the next thing, which is the PBT. Okay, PBT. Sir, why we are not preparing the whole format? This could come in your mind. See, beta, it's not always important that the format which is given by the examiner, you also have to apply the same format. No. The examiner has given the question starting with sales, then gross margin, then administration, selling and distribution, and the PBT. It's not required that you also have to follow the same thing. Okay, you have to do only the things which is required to arrive at your answer. Okay, the main requirement. So if you are doing in exam, so fine, but directly you can go for it. PBT is 10% of this, so it will be 2400, 2880, 3456, and 3456. Clear, beta? So till now we have not done anything technical. So PAT, okay, so PAT comes to how much? 70% for this. Why? Because as you can see, it says the tax is 30%. Okay, and then you have the PAT with. Clear? Okay, so now comes the figure. PAT will be 2400 into 70. Okay, so 1680, 2880 ka 70%, 2016, 3456 into 20, 691.2, 3456. Sorry, 241. 2419.2 and 2419.20. Okay. Now the beta depreciation. Okay. Now the depreciation impact we will be taking up. Okay. So again, as I told you, that could be a little thing for you. So I'll tell you how to do that. Okay. So the depreciation is about 10% per year. Okay, 10% per year. So you can say your how much fixed asset will grow. That is the main important thing. Okay. So how do you calculate the depreciation? Currently, you have fixed asset that is given in your column after balance sheet information. That is 8,000. Okay. So currently, you have the value, opening value as opening WDV as 8,000. Okay, beta. So you can write the depreciation here. Okay. 10% at the beginning of the year, that is 800. Is it clear or not? You have already given a question, already given in the question that the value of the fixed asset as on that date, because that's a closing balance sheet. Okay, that's a closing balance sheet. Now you're starting your new working for 1, 2, 3, and 4. So when you arrive in the first year, okay, when you came in the first year, what was your opening value? It was the value which was the closing value of that. Yes or no? When you arrive at the first year of the new strategy, the opening value would have been closing value of that year. Okay, so that will comprise of how much? 800. Okay, so next will be how much? You have to see. So it will not remain same every time because there is some addition in the fixed asset side. Okay, getting my point? Is the first year depreciation clear? 800. Yes. Okay, now comes this. When you have to calculate the second one, you will have to also see that is there any additions to that? Okay, yes or no? So is there any additions to the fixed asset? Yes, sir. How much? You can see where has it written? If we say at all, the growth will be the gross margin ratio, asset turnover ratio. Okay, and income tax will remain same. Okay, that will remain same. So okay, and the depreciation will be opening for that. Okay, so what will be the next this thing in this? The addition to fixed asset. Okay, how do you present it? You can see the addition to the fixed asset will be the 10% towards this, that is 2400. Okay, clear? So if you are not very comfortable with this, we can go for the traditional method where we are making that debit credit wala thing. Okay, so before I proceed further, there's a doubt from Namita Goel. Okay, so let me just address, it's a big question. Hi Namita, very good morning. Sir, in income-based approach, expenses, yes, income-based approach, okay, which are non-cash, need to reduce from EBITDA. So tax can be non-cash, is it need to be paid to the government? Okay. So again, a very authentic question, I would say, rather, because a lot of students face this problem. Let me repeat out what she's asking. She's asking for a very valid question. Before we continue with the question. So Namita is asking, sir, when we are following an as income-based approach, absolutely. The second one, right? First was the fixed asset. Second was the income-based approach, right? Which are non-cash, need to be reduced from the EBITDA. Yeah. So beta, either you can directly, if the examiner is giving you an EBITDA, Namita, dhyan se, huh? If the examiner is giving you EBITDA, so depreciation must have been deducted. Yes or no? Clearly, if the examiner is giving you directly in the question as EBITDA, so it means that depreciation is already reduced. Okay, so you can't go back and change depreciation. So you can take the tax impact of the depreciation, tax benefit. You are getting the point, okay? Because that's a non-cash expenditure. Okay, so how tax can be non-cash? It needs to be paid to the government. So I never said beta tax is a non-cash expense. It is basically just your presentation. Okay. I'm saying that when we value the value of the firm based on this income-based approach, we say that we calculate no PAT. No PAT means that how much amount of net operating income that we will have after paying taxes to the government. So it's just not that we are not paying any taxes, we are paying the tax to the government. It says what is the net operating profit after tax after being paid to the government, because depreciation gives you a tax benefit. You are getting a point, Namita? Beta, depreciation, when you minus it, okay, when you reduce it, it gives you a tax benefit. Yes or no? Yes, sir. So whatever you amount you get, so actually depreciation gives you a tax benefit, but nothing came out of your pocket. Okay, anything came out of your pocket after depreciation? No, it's just a non-cash expense. So we add that and we get to know that what is the cash flow after taxes for that company. So that is why we make such presentations. I hope, Namita, that's clear. Okay. Sir, in study material, it is written that income-based approach is suitable for those companies who can continue the business of target company without liquidating assets. Absolutely, beta. Absolutely. You know, your question has the answer. Such brilliant student you are. Your question has the answer itself. Read your question carefully. You are saying, sir, income, it is suitable because what is income-based? Okay. So you are not supposed to, what you're not supposed to do is don't have to sell the assets. You just have to earn the income. Should I give you a very simple example? Should I give you? Don't take it personally. It's a very simple example. Okay. Take, for example, that any Domino's pizza, the Domino's company is there near your home. Okay. Okay. You go and buy that company. Okay. You go and buy that company, whichever is near to you, any mall mein hai ya anywhere over there. Okay. You bought that shop completely. Okay. Can you sit there and start earning the income from the very first day? Obviously, yes. Are you supposed to sell any assets over there, sir? Why would I sell the assets? That will give me the income. You know, so what study material has written is absolutely correct. Income-based approach means you are sitting in that Domino's shop, okay, and you are earning from the very first day. You're not supposed to liquidate any asset. You don't need to sell any asset. You sit there and start earning. Will a person coming as a customer, is it matter is Namita is sitting or Sushant is sitting? It doesn't matter. He wants to have the pizza, and he will have that whosoever the owner is. So that's the okay. Okay, beta? Clear? So your question has the answer. So became easier for me. Okay. Okay. So should I go back to this now? Okay. Opening WD is 1000. Okay. So can we go to that debit credit wala approach if you wish to? Okay. And we have, where were we? I've forgotten. Yeah. Okay. We were at depreciation, right? So this is the 800. I hope you have understood. Okay. So this is 8000 ka 10%. Okay. Now how much depreciation will be there? Let's see. 800 ka 10%. Okay, yeah. So okay, so 20% increase. So 960, 800 ka 20%. I have done that. Okay, with 960 ka 1.2, so 1152. Okay, and that will be also 20% increase, 1382. Okay, beta. Have you understood this figure or not? Very simple. Just tell me this figure. Yes, 800 was given, then uska 20%, then uska 20%, then uska 20%. Okay, because as we did in the earlier questions, if the sales grow at 20%, the other assets will also grow at the same percentage. Okay, but it says the gross margin ratio, which is this, that will remain same. The asset renovation, we are about to come on that, and the capital structure and the income tax will remain unchanged. So what is the capital structure? 12,000 equity is given, that will remain same. Taxes 30%, that will remain same. Okay, so depreciation will be 10% of the net fixed asset at the beginning of the year. Okay, beta, clear? Okay. So then we can know what is the addition to the asset. Okay, addition to the fixed asset. Okay, so can you calculate that? Shall we go to the very traditional approach? Okay, so have a look. This is fixed asset. You remember your 12th class, 11th class? So BDCD to BD, okay, 8,000. Okay, and your depreciation comes on credit side, debit side. You remember? Depreciation is 800. Okay, for that particular year. And what is the closing value? You can calculate. Okay, and what is the addition? So to CD by bank. Okay, this is what you have purchased. So 8,000 plus 2,400 minus 800. So your CD becomes 9,600. Clear, beta? Hope you remember. This was your asset purchase. What entry you were making? Fixed asset to bank. Debit what comes in, credit what goes out. So bank will be credited. It will come over here. Okay, and 2,400 is the addition, and this becomes your closing balance. And for that, you're taking the 10% of this, and then so on for the 4 years. Clear? Done? Chalo. Let me rub this. So additions to the fixed asset, 2,400. Okay. And 9,600 opening ho gaya, minus 960. Okay, and minus 11,250. Okay, 2,880. How did I calculate this? Okay, अब opening क्या हो गया बेटा? The opening will be 9,600. Okay, depreciation is 960. Okay, this one, and your closing balance is 9,600, and with this depreciation. Okay, 9,600 minus 9,660. Okay, minus 11,520. Closing is A1, 11,520. So your addition becomes this one. Whatever method you want to follow, you can follow that in exam. That's not a problem. Okay, chalo. 2,880, and then further will be opening was 9,600 is opening minus depreciation plus 1380, okay, and that will become 3456. There is no there is addition. Okay. Good morning, Shubham. How are you? Doing great. And this is the addition. Okay, clear? Any doubts, guys? Okay, clear? So now you can see how much is the increase in the working capital. Oh, sorry, increase in current assets, not working capital is not required in this question. How come I said that? Okay, so fixed asset is given 8,000, current asset is given as 4,000. Okay, so can we see what's the increase? Okay, so from the earlier one, so how much are we increasing? Can we calculate that? Any doubts still here? No doubts? Okay, so this is the addition. So we can do it little later. Space. Okay, let me prepare it in the next thing. So can you calculate the fixed asset again? Yeah, sure. I can calculate the fixed asset again. That's not a problem. Okay. Let me show you in the next slide. Okay, just wait. Okay, so fixed asset, how much is given? 8,000 is given, beta. Yes or no? Yes, sir. So 8,000 divided by 20,000. Sir, what is 20,000? Beta, sales. Okay, sir. What is asset turnover ratio? ATR is fixed asset by sales. Yes or no? That is why I was telling you that be clear with the ratio analysis. Clear? So 8,000 divided by 20,000. So it says 40% is of the sales. So can you calculate the fixed asset schedule? Yes, sir. So chalo, calculate kar lo. You can calculate that. Okay. 1, 2, 3, and 4. Year 1. One, 2, 3, and 4. So this is particulars. So this is your fixed asset. 40% of the 8,000 value. Okay. So earlier was 8,000. So 8,000 ka 40% will be 9,600. Okay. Clear, Namita? But this question was asked by some other student as well. So that is I'm sure. Please show the addition to fixed asset calculation. Okay. Now you will understand that. Okay. Fixed asset turnover ratio remains same. Okay. So you have to keep it at 40%. 40%, how have I calculated? Is it clear? I hope so. Okay. Now, so first year fixed asset will become 9,600, 40% of that. Further 9,600 addition to that. Is it 20, 40% sales? Okay. So what is the next year sales? 2,800. Okay. Was there? Uska 40%. 1152 कैसे आया 2880 का 40%. Clear? And then further you have another sales 34560 uska 40%. 4 and 13824 because the sales are same. Okay, so this figure is 34560 iska 40. Clear beta Namita? Fixed asset calculation. And uske saath hi similarly we can do it for the current assets as well. Current assets. Okay, what is that? You can see it is 4,000. It is given divide by 20,000. So can I say if it was 40%, it will be automatically 20% of that. Okay, so 20% of the sales. So sales first year was 24,000, uska 20% means iska half. So we can directly do half of everybody. 4,800, 5, 7, 6, 0, 6, 9, 1, 2, and 6, 9, 1, 2. Clear, beta? Done. So you can get your total assets. So 0, 0, you will get 4, 1, 4, 4, 0. Okay. So 17280. 13824 6912 20736 and 20736. Clear, beta? So is the schedule clear, Namita? Just confirm, bacha. That's clear. So can we move to that to calculate the FCFF from this? Yes. Take you back to the assignment. Okay. So now is it clear? Where was those sales values? Okay, just one sec. Okay. PAT was 70%. 2400 ka 70%. Okay. 1680. 2016. And 2419.2. Okay, clear? Depreciation, you already had calculated 800, 960, 1152, and 11. No, not that one. 241. So that was. So yahan tak to we have already done 1382. Clear? So now can you tell me what is the additions to the fixed asset? You have that schedule earlier wala. So you can see it was increasing from 96,000 to 9600. Okay. To 11520. So you can see the addition. Okay. So 11520, the one we calculated minus 9600. Okay. So the, okay, sorry. Fixed asset addition. So we've already calculated that. Sorry. So it was another one. Okay. Sorry, it might confuse you. We had already done that addition wala thing. It just got removed from here. 2400 to 880. Yahan tak to we have already done. Hai na? 3, 4, 5, 6 and 1380. Okay, beta, clear? And you can see what is the additions to the current assets. So schedule was already there. If you are aware. And the depreciation. Additions to the current assets. So earlier it was opening was 4,000. Okay. And then it was year 1, it was 4,800. Year 2, it was 5,760. Okay, and so on from that schedule. So the change is 800. Okay, and the change is 5760 minus 4800, that is 960. Okay, third year was 20% of the sales, right? Iska 20%. 34560 ka 20%. So it was 6912, and fourth year will be 6912. Iska difference minus 5760. 1152. 1152. अच्छा nil था यहाँ पे. अच्छा sorry, there was no change here. Same ना, that was same, so it will be nil. ठीक है बेटा, अब clear है? Sir, in question ratio of CA is not given, so why we calculated CA figures? बेटा there is a change in the CA as well ना. Asset turnover ratio में तो दोनों चीजें cover up होती हैं नमिता. I'm sure you know this. Okay, you can't forget this, है ना? So asset turnover ratio will have both the things. First, we need to know what is the asset turnover ratio. So fixed asset by sales for both fixed asset as well as current asset. So whatever is the additions to that, we will have to take the impact for our operating cash flows. Yes or no? है ना? अब if your earlier doubt gets clear, वो बताते नहीं आप, है ना? Is that clear? So till here it is done. So now we can just complete this question by calculating the operating cash flows, and from there our next operating cash flow. ठीक है बेटा? How do we calculate? Now see very carefully. This step is little might be new for you. Okay. So you have PAT 1680 minus add back depreciation. Okay, so this is PAT. You add back depreciation, and if there is an addition to your fixed asset, that will reduce your cash flow because you're putting in more money. You're getting the point? So don't just stratify that you have to reduce it or add this. Okay, just understand that in cash flow after taxes, you add back depreciation, and if there is any addition to the fixed asset and the current asset, that will reduce your cash flows. Okay, so that will be a negative figure, so you have to add this and this. So you will add 1680 plus 800, and additions is 2400 minus 800, so 720, negative figure. Okay, so plus 960 minus 2880 minus 960. So 864. Although this get deducted with this, but still I thought I'll show you. So 864 negative. Okay. So 2419.2 plus 1152. Now I can just cancel this, right? This and this. So 2419.2 and minus 3456. Okay. So 1036.8. Okay. And now this gets cancelled, this and this. So you'll get net 2419.2 operating cash flows. Is it clear till here, Namita? कुछ बोलते नहीं हो आपकी मुझे clear हुआ नहीं हुआ, I'm not able to understand. My God. Okay, this is clear. So next step is becomes your present value factor. You have already calculated the cash outflow. So unfortunately they are coming in negative. Okay, unfortunately they are coming in negative. So you will have this present value factor at the rate of 15%. It is given over here. Can you see? Okay. So company target rate of return 15% means that's it. Okay. Thank you, Namita. Thanks a lot. So nice. So 1 divided by 1.15. Okay. So that will become 0.869, 0.756, 0.657. Okay. And for the fourth year, right? Okay, we'll do the residual value for fourth year. Just wait, huh? We have to do certain calculations. Why? Because that's a terminal value, right? So can we calculate the present value for this? Definitely. This, and this. We will do the terminal value calculations over here. Okay, after this is done. So 720 minus mein hai, so 0.869. So that will be 625.68. 864 into 0.756. So that becomes 653. Because all the figures are in negative. $681.1. Okay. 0.18 plus 625.68. Total. Abhi, just for calculation, I'm keeping it. Okay. So that we can use it later. 03. Okay. Question is not over, guys. Huh? Just I've done this working so that I can rub the blackboard and then I can move further for the next calculations. Okay, clear? So the present value of 3 years is coming out with 160.03. You might have 1 or 2 rupees difference. So that's completely acceptable by the examiner. Okay, chalo. So now let's go back to the other parts. Yeah. So total present value. Inventory present. Sorry. Total present value 1960.03. Okay. So next is your terminal value. Okay. So terminal value, how would you calculate beta? Okay. So remember your last figure. Okay. That is 2419. So you will do 2419.620 divided by 15%. Why? Because it says it will grow in perpetuity. Okay. This is what basically is there, valid for the next 4 years. A new sales strategy, they want to make the strategy. Okay. So divide by 15 as the residual value, terminal value, residual value. So that comes out to 2419.2 divided by 15%. Okay. So 16128. Okay. That is there, and divided by your 15% third year figure. Okay, clear? So third year figure was 659. Is it? Yes. So that comes out to be 10628.35. Clear, beta? Any doubts? Okay. Thank you so much, Namita. Sir, I have not attended secure, so please explain detail why you are dividing KO while calculating term value. Okay. I'll do that, Namita. A lot of students have this query. So you are actually indirectly helping your other co-friends as well. Okay. I'll just tell you. Okay. Okay. So is it clear till here? Any doubts? Let me just check the other question. Other your queries. Okay. This is okay. 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 So this becomes your total value, but we are not supposed to give the total. Okay. We are not required to give the total free cash flow to the firm. No. Okay. We have to say the incremental value, the difference between the value that you will receive after the adoption of the strategy. Okay. So the requirement is little different from what we did in the last class. Okay. Now this is the first thing that you know. Now the second thing is, she is asking, sir, why do you do this concept which is called as KO minus G? Okay, so beta security valuation, you have the concept to calculate the KE when you say D1 upon KE minus G. Okay, so D1 means the dividend for the next year. So similarly, I said in the last class, this is called as the Walters model. I hope you have done your Walters and Gordon's model. It is given in your study material very nicely, very beautifully. In the old course, it was in much more detailed, but then in the new course, it was cut short with some good examples in the study material so that you can understand that. So D1 means the dividend for the next year divided by KE minus G when we say that the growth will be in the constant term. Or you might have to calculate the growth as well in few questions in the security analysis. So similarly, we say that this is FCFF1 means the free cash flow firm to the next year divided by KO, because here it was equity and here it is both equity plus debt minus G. So here the growth is not given. Okay, so G is nil. So we have just directly divided by 15% because it is only the KO. Okay, so is KO you can also call it as WACC, not a problem. Weighted average cost of capital. The calculation we'll be doing more today on the EVA concept. Clear? Sir, you said that when company not able to keep track of the dividend paid, then we need to calculate the value of business using cash flow approach. What is the logic? No, I did not say keep the track. ऐसे मत बोलो भाई. I did not say that keep a track. When I said that when the companies is not paying regularly, okay, regularly. So we calculate the value in the cash flow terms. Now you tell me one thing. Before the IPO of Nykaa or Paytm or Zomato came, did you read its? Did you went through the red herring prospectus? No. They are basically trying to see that what will be the cash flow that they can generate from the coming years. The company has not paid the dividend, and the company was coming with the IPO. So for that purposes, they are using the concept of free cash flow to the firm method. So when the company is not paying regularly dividend, so that is the reason we calculate the FC. I hope that's clear now. Okay. Any other? Sir, we have read 3 approaches. What is the reason how these approaches come into existence? Because it is very simple. See, again, if I say something, it will go out of the turn. Let me just tell you. See, the first one is the asset one. Okay. When you value from the historical value of all those things, that is required when you are valuing a company which is almost at the liquidation value. Okay, I mean the company is about to get over, so you pick their assets and see their realizable value. Income approach you follow when the business will start giving you income from the very first day. I gave you that Domino's example. You buy that company, you sit there and start do the billing of the pizzas and start taking the money at home. Third one is the free cash flow, where the company is not paying dividend regularly and the company is getting merged, or either they are getting into this what do you call this IPOs and all this. Is it clear? Okay. Okay. Yes, that's it. Okay. So quickly we can complete this. So we can have to give the incremental value. So let me calculate the incremental value out of this. Okay. And before we lose our contacts, let me stay connected with you. Just a moment. I don't want to lose the contact with you guys, so that's important. Okay. Done. So incremental value, beta. So value. Okay. Incremental value means what is the change in, that is change in terminal value minus the year 1, 2, 3 combined. The study has given a better meaning than me. Okay, a better meaning, better name. Okay, so it says incremental value is nothing but your total shareholders value. I found this more appropriate. Okay, the steady material language. So it is nothing but 10628.35 minus 161960.03. So that will come out to 1628.35 minus 1960.03. Okay, so that comes out to be 8668. Okay, this. Okay, beta, value. So this is the net incremental value that you are getting from there. Okay, so that is the answer. Clear? So if you want to say that whether it is good or not, this, how can you say? You want to know what is the pre-strategy value, I mean before this new venture. So you can say in the exam that pre-strategy value is equals to, earlier it was 1400. You remember the PAT? The PAT is given as 1400. So 1400 divided by 15%. Sorry, 15%. Okay, this 15%. So that comes 9333. Okay. So earlier your value was, your company's value was 9333. Now after when you do this all new sales strategy, your shareholder value will be 8618. So is it good or is it bad? So obviously bad. Earlier we were getting the valuation as 9,333 crores. Now after this new sales strategy, I think because since we are doing a lot of investment in the fixed asset and the current asset, we are getting a net shareholders value as 8,618 only. So our value of the strategy is not financially viable. Okay, let me give you the answer. Earlier value before new strategy was 9333. Okay, shareholders value after this thing, which is called as your new sales strategy. Okay, that is 8631. Something was there maybe. So net becomes 702 in negative. So therefore not financially viable. Clear, guys? Done? Any doubts? Sir, why is it like that this company not pay dividend regularly? They follow cash flow model. What is different in this model as compared to other two models? But Namita, I told you very exhaustively and comprehensively in the last class, beta, the very first class. I'm not sure whether you were present or not. I gave you very clear this thing that first we use the historical cost in the companies where the business is there, but they are no more into existence. So we sell the fixed asset and we take the realizable value. Second thing is income method, where the company is regularly earning income. The Domino's example I gave you. And the third one, where the company is not paying you dividend and the company is about to get merged or being controlled or going for an IPO or FPO. So we are doing the valuation based on the free cash. So I hope that is clear. Okay. Any other student, any other doubt? So we are done with this. Now we can start with a very good concept, which is called as the gearing of the beta. Okay. So you will definitely like this concept of the gearing of the beta. You have any doubt, so you can ask me. Otherwise, I will start with its question. Okay. I have good examples and understanding of that. Okay. So just do the chop shop method and interest coverage ratio yourself. It is given very nicely in your study material. Okay, chop shop and the interest coverage ratio. Very, very simple concept and very nicely given by the study material. Okay, so let me take you to the whiteboard now. Okay. Now, gearing of beta. Now, first of all, what does this basically mean? Okay, what does this basically mean? It's a very simple. Thank you, Namita. Thank you so much. Beta, basically, gearing of beta, what do we do and what is basically it is meant in your life that is there. When we talk about SFM, okay, our paper number 2, we have beta of two types: equity and asset. Yes or no? Yes, sir. Where have you applied the equity beta? Sir, we have applied the equity beta in the concept of CAPM. Remember, RF plus beta, RM minus RF. So which is this beta? Which is this beta? Is it overall beta or is it equity beta? Sir, since you have already, other sir has already taught us equity beta, so this is must be an equity beta. Absolutely correct. Absolutely correct. There's no, disagreement with that. Definitely, whatever been taught to you is absolutely correct. Asset beta might not have been taught or might not have been clear as far as its implications is concerned, its application is concerned. What does asset beta means? When beta, we are doing a valuation of our company. Okay, we might not have the data for our own company. We try to take some data from some other company. Sir, what does that mean? Yeah, I'll explain you. You know what do you mean by peer companies? Yes or no? Yes, sir. The companies which are in similar business, Let's take any business, let's say a broking business, because these days broking is doing great. Okay, depository business, broking business is doing absolutely great. No recession, nothing. Okay, so let's say there is a broking company who is yet to get listed and they wants to know their own value, so they can take some of the data. I'm not saying the entire data. Obviously, you might be a small broker. You cannot compare yourself with brokers like Zerodha or Sher Khan or all these angel broking. I don't know. I mean, all these companies, you cannot compare yourself. But yes, you can at least have something. What, sir? I would say the concept that if I say that if the economy goes down, sir, how would the economy go? Let's say that people are not trading in securities. Okay. Rather than broking, let's take a hotel business because that is a very seasonal one. Huh? Why to take this thing? Let's take hotels. Okay, let's take the hotels because you have ITC and all those things. Okay, yeah. So if the economy goes down, when does the economy goes down? When the inflation rises. Okay, your cost of living is not appropriate. So how will the hotels? Will all the hotels have a equal impact? Yes, sir. Will the government says, Modi government says, you can open up half of the hotels and half of the hotels needs to be closed? No, that's not the case. Clear? So in that particular case, you have to see what will be the impact. Okay. Sir, what is asset beta? We have never heard of that. That is the reason I am here, Namita. Don't need to worry. Okay. So when I say that a company has asset beta equals to 2. Listen carefully, huh? It's very simple. Okay. The company has an asset beta. Sir, can the examiner give us the overall beta? Yes, yes, they can give you overall beta as well. Equals to 2. What does that mean? Listen carefully. If the economy goes down by 10%, if the economy goes down by 10%, the assets of the hotel business goes down by 20%. Sir, what? Yes, you heard it right. You heard it right. If the economy goes down by 10%, okay, the overall beta, if it is 2, means the assets will go down by 20% in their valuation. Okay. What does beta basically mean? If you go back to your security valuation chapter or security analysis, no, okay, security valuation chapter. What does equity beta means? That the teacher must have given the example. So let's say the value of Reliance and its beta is, let's say, 1.3. I don't know what's the beta. I don't trade. So I'm just telling you an example. So let's say Reliance Industry has a beta of 1.3. So what does that mean, beta? It means that if the Nifty goes up by 10%, okay, if the Nifty goes up by 10%, the Reliance value will go up by 13%. Yes or no? If you don't know this, then it's a serious thing that you have almost about to complete your course and you're not aware of. This is a very important thing. And on the contrary, if the market goes down by, let's say, 5%, okay, 5%. So what will be 5 into 1.3? So the Reliance value will go down by 6.5%. That is called as equity beta. Sabko pata hai, this is clear to everyone. So now the asset beta means that if the economy goes down by 10%, okay, the value of the assets will go down by 20% because the asset beta is 2. So what about this is 2.5? So if the economy goes down by 10%, the value of the assets go down by 25% because that is 2 point. Multiplication beta. Similarly, is it clear, guys? Any doubts still here? Please let me know. Is it clear or not, guys? Is it clear? 20%. So now let's understand basically how the question can come in the exam. So the examiner can give you that there is a FCFF. Let's say rupees 10 lakhs, which is perpetual in nature. Okay. And you will be given other informations as well. Okay. So let's take an example. The RF is 6%. Okay. And RM is 10%. Clear? Yes. And it says the overall beta, or the examiner can give you the asset beta. The example that I just give you, that is 2. Okay. It says what will be the decrease in the percentage decrease in equity. Okay. So let's take an example that before COVID, the company's balance sheet was this. Okay. Just take an example. The equity was let's say 6 lakh. Okay. And the debt was 4 lakh. So total was 10 lakh. And the fixed assets were 10 lakhs. Okay. So afterwards, after COVID, the equity gets reduced. Sir, why? Arey, you will have losses. You will start using your reserve and surplus. Yes or no? Yes, sir. And your business was down, but still you had to take the benefit of the debt, that is 4 lakh. Okay. And as a result, your assets becomes 9 lakh. So what is that percentage decrease in the equity? How do you calculate that? How do you calculate? Sir, it's very simple, sir. It is mathematics. I would say that percentage decrease. Okay, percentage decrease in equity is, earlier it was 6 lakhs. Okay, now it is 5 lakh. So 5 lakh minus 6 lakh divided by 6 lakh into 100. Okay, yes, sir. Divide by 6 lakh. So how much reduced amount? That is 16.67%. Okay. Clear, beta? No doubt? And you can calculate the percentage in the decrease in the equity. Sir, what are we doing till now? Beta, we are just trying to tell you that what is the impact on the company's balance sheet when a situation comes which is unfavorable for the company, or maybe which is very favorable for the company. As of now, I have a very hot and a trending example of COVID. Hotels are getting affected, restaurants are getting closed, cinema hall, gyms are all closed. So they are getting impacted. So we are just trying to see what is the decrease in the equity. This is clear? Yes, sir, this is clear. So if this is a percentage, okay, so I can say that the beta of the equity is change in equity by change in economy. Okay, so how much the percentage change in the equity is 16.67, the value that you just calculated, okay, divided by 10%. We are assuming that the economy is down by 10%. So what is your equity beta? It becomes 1.667. Are you getting a sense? People think that asset beta and equity beta are same. No, they are not same. Equity beta says that the value of the share price in the stock exchanges, whereas the asset beta says the change in the value of the business because of the increase or decrease in the economy's conditions. That is it. Is it clear? So, sir, what is the difference between them? This could be a question. Yeah, but both are absolutely different. Asset beta means the value of the company go down or go up if the economies increase or decrease. And beta of equity means that the change in the equity value with a change in the economy. This is clear? Yes, sir. This is clear. This is pure mathematics. Sir, are we supposed to show it in this way in the exam? No. You will not get the marks if you show it in this way. Okay, sir. So how can we show that? Definitely, I'll tell you. I have taken this thing because the study has shown like this. And again, after that, study has also shown how you have to present in the examination. So I will show you that. Okay. So you would say, if we have to calculate the beta equity, okay, you can use this formula, overall beta or the asset beta. Now we are coming to the study language. Study language, study material ka language. Beta of equity, this is the formula. E upon E plus D, okay, plus beta of debt into D plus E plus D. The study has also given you the steps as well, which I have put it in the PPT, which I have given it to you. Okay, so you can read that as well. But again, all the credit to the study material because I've taken it from there. Okay, so since debt is considered to be debt risk free, debt is considered to be risk free. Okay, so this BD, this one will always be equals to 0. And this is pure math. Something which is multiplied by 0, the entire will become 0. Okay, sir, why are you giving us the derivation? Beta, you should know that. Study is also given in the same manner. Okay, okay, sir. So this entire becomes 0. Okay, so we are remain with only this. Yes, sir. So what was the answer? 2 is given, already given. Can you see? Okay, and beta of equity into the balance sheet after earlier, which was there. You remember 6 lakhs and 5 lakhs. Okay, 6 lakhs and divided by 6 plus 4. This is what we did. I think so. Is it so? Just one second. 6 lakh. This is what we have in. Then becomes earlier one. 6 lakh and 4 lakh. Okay, 2 is there. Yes. So 2 into 10 divided by 6. What was the earlier example? I am just forgetting what the figure I've taken. 6 or 7. I'm just not getting that remembrance. It was 7 and 6 and 4, that becomes 10, and becomes 5 and 4, that becomes 9. Okay. $1.678. So the beta equity, sorry, I just got a little stuck because I don't remember the figures that I taken. Was it 7 or 10? I don't even remember. I've forgotten that. Let's just take some other. Is it so? Because that was 6 minus 5 divided by 5. Okay. Anyhow, beta equity in this case will become 10 into 2 by 6, that is equals to 20 by 6, that is 3.33%. Okay, I mean, this is how you have to show it in the exam, but don't worry, I just forgotten which value I've taken, 6 or 7. Has somebody known that? Sir, what are you? Okay, she's asking something else. Okay, so anybody has done that? I mean, I don't remember those figures. Don't worry, we'll take the next one. You'll understand that how to present in the examination. Okay, so let me take another example. I'll put all the figures over there so that it is more understandable. So you can ignore this for the timing. Just tell me this thing, if that is clear or not. You will get the marks in the exam only and only when you are putting this formula in your examination. Otherwise, you will not get. Okay, we'll take another example and then we'll see how to be present in the exam. Okay, more clear example over here. Okay, just one thing. Example. Okay, so let's say there is XYZ Limited. It's a hotel industry. Okay, now we are going exam oriented. So you have the cash flow after taxes, which is perpetual, which is, let's say, 5 lakh. Okay, your RF is 6%, your RM is 15%. Okay, and now I'll take the proper balance sheet values. Okay, so your equity is, let's say, 7 lakh. your debt is 3 lakh. Okay, the only balance sheet that will have, and the assets, that is 10 lakhs. Clear? And your overall beta is 2. Okay, so how do we have to proceed in the examination? You have to first calculate your cost of equity. Okay, I told you in the last class, the hint, if the examiner is giving you RF, so it means they want you to calculate the CFM. So we can calculate that. Okay, what is CFM formula? Sir, RF plus beta, RF minus RF. Oh, sir, we don't have a beta. Now what to do? Sir, we have a beta? No, this is beta, overall beta. Okay, you have to calculate the value of the firm. You have an overall beta, but you don't have an equity beta. And with equity beta, you will calculate your cost of equity. You're getting my point? Okay, come back again. Beta is not there. So what you can do is, you can calculate the beta first, not a problem. Okay. So with this formula, we can calculate that. Okay, now it will be more clear to you. Don't worry. So the calculation of equity beta from overall beta. Okay, so okay, so let me write the entire formula. So beta of the asset is equals to beta of the equity into equity by debt plus equity. Okay, so with this you can say 2. This is given over here. This is what we require, into equity is 7 lakh and debt plus equity is 7 plus 3. I took 6 there, I don't know. Anyhow, we'll calculate that. Okay, this is okay. So beta of equity will become 10 into 2 by 7. So that becomes 20 by 7, 2.857. This is little different value what we got, but again, it's an example. Now we are starting with the exam oriented things. Is it clear? Is the beta clear? 2.857. Okay. Now let's put that value over here. 2.857. Just write that. Okay. Now I will be calculating the value of the firm using this value. So you can say the value of the equity. Okay, can you calculate that? Just 1 second. So cost of equity kitna aayega? 6% plus 2.857, this beta. Okay, and the difference between them, RA minus RF, 15% minus 6%. Okay, and you will get this as into 9 plus 6. So, oops, 9 into 8 point. हाँ ठीक तो है, ठीक है 8 point. हाँ ठीक तो है. 9 into 2.857 plus 6. And just an example, not a problem. 31.71%. Okay, and what you can take as cost of debt? Nothing but the RF. Yes or no? Sir, why? Because that beta tax is not given. So we assume this is post-tax. Has the taxation I've given it? I'll give it to you in the few other examples. Don't worry. But this is the concept. Okay, clear? Yes, sir. So cost of debt becomes like this. which is 6%. Okay, so can we calculate KO now? Yes. So 31.71% into, now you can see 7 by 10 plus 6% into 3 by 10. 3 by 10. This becomes your WACC. Okay. So into 7 by 10 memory and 6 into 3 by 10 memory. Okay. So it is coming out to be exactly 24%. I mean, just coincidentally 23.991. So you can take that. So now you can calculate the value of the business. Yes or no? Value of the firm, or let's say the business. You have this cash flow after taxes divided at 24%. So it comes out to be 2083333 and so on. Is it clear now, guys? Now I will take some doubts. I think Namita is asking. Oh, just got stuck. Good morning, sir. Beta is shown in number. Debt is 4. Thank you. Equity. Thank you, Naveen Prakash. I'm so sorry. I just saw your this thing. Namita is also saying it was 6 lakhs and 4 lakhs. Sorry. I just forgot. Now I've taken the concrete numbers and I'll stick to that now so that it doesn't create a problem. Okay, don't worry. So I hope this concept is clear. I'm sure you guys would have done, because you guys are very, very attentive and very regular in the classes. So I'm sure you will have to do that. Sairam is saying, sir, beta is shown in a number. Beta, yes, just like beta, I would say, what do you say in equity beta? 1.3. It is 1.3 times equity beta. Whereas similarly, the overall beta or the asset beta is also in number terms, which is 3, 4, 5, 6. How much times will there? The impact will be in percentage, but it is always in a number. So if I say the economy is down by 10% and asset beta is 1.5, so the assets value will be down by 15%. So impact is taken in percentage, but it is shown in a number. Clear, beta? Thank you, Shubham. But now it is done. I think now you can concretely understand with the help of this example. Clear, Hannah? No problem. Okay. Okay. So now let me take another little different thing, a little tough thing with you. Okay. Have you heard about debt equity ratio? Yes, sir. Definitely. What if the examiner do not give you the balance sheet? Oh, so can we do that? Yes, sir. Sure. Now we are doing calculation of value of the firm using beta. Okay, so let's say the FCFF is equals to 1,50,000 perpetuity. Okay, your RF is 6%, your RM is equals to 4%. Okay, and you are given a debt equity ratio of 1:4. Clear? Your overall beta is in number, which is 0.90. You have to calculate the value of the firm using this beta. Now this will be very simple to you. Kaise? Dekho. Beta, overall beta is equals to beta of equity into equity by debt plus equity. Okay. So this is what we require. So we can plot it here. 0.9 is equals to beta of equity into, oh, debt equity ratio mein given hai? Yes, sir. So debt equity. So equity is 4, debt is 1. Equity is 4, debt is equals to 1. So equity is 4 by 1 plus 4. Is it clear or not? Okay. This is how we have to do that. Okay. So can we calculate the beta of the equity? Not a problem now. 5 into 0.9 divided by 4. Has everybody got this answer? 1.125. Has everybody got this answer? I'm sure you must have. So now you can calculate the KE. Okay, let me just refresh this. Okay, so can we calculate the cost of equity now? Yes, sir, definitely. So let's calculate the cost of equity. So RF is 6%, 1.125, or RF minus RF. So 6 minus 4. Okay, so that becomes into 2 plus 6. So that will be 8.25%. Cost of debt remains same till the time the taxation is not given by the examiner. है ना? Sir, what if the tax will be given? So simply do 1 minus tax. What's the big thing? Okay. So KO will be how much? 8.25 into, now the calculation will change, 4 by 5. Okay. Same like this. Plus, you can say 6% into 1 by 5. Okay. So you will get into 4 by 5 memory and 6 divided by 5 memory. 7.8%. Has everybody got 7.8%? Okay. And you can get the value of the firm with this. $150 divided by 7.8%. 19.23 lakhs. Clear everyone, guys? Simple or not? Now it becomes quite simple to do this calculations. Now in this I gave you the debt equity ratio. Okay. In the other case, now I am giving you a more twisted information. Just have a look properly. Okay. Should we do that? Any doubts still here? I'm sure you might not have. I know where the students stuck. I know where they stuck basically. Okay. So now I would say there is a company called DEF. Hotel company. Okay. So they have a FCFF of say 5 lakh. Okay. RF is 6%. RM is 12%. Equity, let's make it easy. Those 7, 5, 6 numbers are really tough. Equity is 5, debt is 5. Okay. Now the new thing, tax is 30%. Okay. What is the value of the firm? Okay. Sir, here again, it's not very different in the example that you gave the last time. This might be coming in your head. Sir, there is no difference. There you gave the debt equity ratio 1:4, and here you are given equity and debt. What's the big deal, sir? It's nothing but 1:1. No, I'm coming to that. The examiner will give you the average overall beta of hotel industry is 1.2. It's not yours. It's the average of the all hotels put together. The Taj, Mansingh, the Radisson, okay, the Holiday Inn, the Holiday Out, all those hotels, overall beta is given to you. Okay. So we generally assume that your company will also have this same overall beta as the any other. Okay. So accordingly, we use the value. Okay. So you will write, it is assumed that DEF will also have same asset beta, which is 2. Okay, so you can calculate the beta equity directly. Can I now manipulate the figures? That is so this is 2, this is required. Equity is same 5 by 5. Okay, why I'm smiling? Because the tax rate is given now. Clear? So you will say 1 minus 0.30. Now there will be a change. In the exam, our students do a lot of problems in this case. You should not be doing. Okay, clear? So 5 into 0.7. 3.5 plus 5, that is 8.5. Okay, so this becomes beta of the equity 8.5 into 2 divided by 5. 3.4. Has everybody understood? Clear? 0.7, right? 5 into 0.7. So this is 3.5 plus 5. This is 8.5 into 1.2 लिखा मैंने यहाँ. Sorry guys, sorry. There I've written 1.2 or by mistake I've written this. Sorry. Now this understand. Sorry. 1.2. Okay, so this figure will change now into 1.2 divided by 5. Yeah, so everybody has got 2.04. So okay, so come back again. What is the difference that we did in this example and against any other example that we have done? Here, the overall beta of that particular company was not given. So in the exam, similarly, you will not be given the same this thing. What do you call the overall beta? So we have assumed that DEA will also have the same asset beta as the all overall hotel industry, that is 1.2. Okay, so with that 1.2, we have calculated our own beta of the. But at the same concept, the gearing of the beta is also there in your portfolio management, I think. Sorry, not portfolio management. Maybe yeah, in portfolio management it is there. If I remember correctly. Yeah. Sorry, Namita. Now it is there. Sorry. By mistake. Okay, because 2 was coming to my mind from the very first example now, so that is why I just put it wrong. So I'm saying this this calculation of the overall beta will also be there in your one more chapter. So just make sure that you are doing this with appropriate understanding. Okay, clear? Yeah. So there's a question from Naveen. Let's understand that question. What is asking? Sir, what is the purpose? What is the purpose of considering tax, sir? Because in case of interest, it is deductible, but why in case is principal? No, beta, we are just taking the impact of the debt equity. That's the thing. It's not, don't take it that since it's a principal amount, so we are not taking. I'm just saying that when you are doing the computation, when the tax is given, we always do that post-tax. Your understanding is absolutely correct that this is a principal amount. Why I'm taking the entire one? I'm assuming that this is the interest amount and I have to take the tax impact over here. So I was just trying to tell you that don't forget the impact of tax on them. That is the only request I'm saying. Otherwise, you are absolutely correct. This is a principal. When we show it in the balance sheet, it is always a principal amount. We take the interest later on. But I'm just telling you that for the examination purpose, take the tax impact in the debt. Otherwise, the beta equity that you'll get will be incorrect and overall your value of the firm will become incorrect. I hope, Naveen, you've understood because this is an example. Okay. Conceptually, you are correct. Principally, में कैसे हो सकता? You are absolutely correct. ठीक है? I'll come to that, Namita. Okay, I'll come to your question. Okay, beta, is it clear? So now with 2.04, let us consider the further things. Okay. So let's calculate the RM. Beta, Namita, the concept is not very, enlarged. It's just that you are trying to calculate value of the firm using overall beta. That's it. Okay. So from asset beta, you're calculating equity beta. Let me write the steps because I think you are not clear with what we are doing. Just wait. Just see here. What we are basically doing in that, with overall beta, we are calculating the equity beta. With that, we are calculating cost of equity. With that, we are calculating overall cost of capital. With that, we are calculating the value of the firm. Clear, Namita beta? With overall beta, we are calculating equity beta. We have already done that now. Okay, the answer we got 2.04. Now we'll be calculating cost of equity, the WACC, and the value of the firm. Clear? Sure. Welcome, Naveen. Always welcome, my dear. Okay. So, Namita, is it clear? Please let me know. Okay. So now, can we calculate the cost of equity? Okay. So you have 6% plus 2.04, 12 minus 6. So into 6 plus 6. So that comes to 18.24%. Cost of debt is 6% because this is the one. Now we can take post-tax. Okay. So 1 minus 0.3. Naveenji, this is the concept. Okay. Now you will be comfortable. 6 into 0.7. So after tax, it will be 4.2. Okay. So now you can calculate the overall cost of capital, 18.24 into, I think in both cases it is same, 5 by 10 plus 4.2 into 5 by 10. 2.1 and 18.24 divided by 2. So no. Seems to be incorrect. Exactly. So 18.24 divided by 2 plus 2.1. So it is coming out to be 11.22%. Okay. And the value of the firm. $5 lakh divided by 11.22%. So 44.56 lakhs. Namita, clear hua? Yes or no? Sir, in these steps, which step is called gearing of beta? From the very first step, that is called as gearing of beta. Okay? The very first step. Okay, so let me do one question with you. Okay. The question name starts with excellent, and actually that's an excellent question. But I think that is not, I have not given to you in the in this. So let me just show it to you in the on the screen. Okay. Just 1 second. Okay, so I will share with you this. Okay, so I hope this question is visible to you. Okay, I hope so. Okay, so now let's understand the concept that how in the exam the question can come as far as this thing is concerned. So Excellent is a just one second. Excellent Limited is a frozen food packing company and is looking to diversify its activities into the electronic business. Okay, it's a very important. Okay, it's very important. The project is considering has an after-tax return of 18%, and Excellent Limited is trying to decide whether the project should be accepted or not. To help it decide it, it's going to use CAP. Okay. The company has to find the proxy beta. Now, Namita, up to you. The company has to find the proxy beta for the project. This is how it can ask you in the examinations. And has the following information on 3 companies in the electronic business. Number 1, Superior. It has an equity beta and financed by 50% debt and 50% equity. If I would have to start with the question directly, you would have not understood now what is an asset beta, now what is an equity beta. Now, first of all, you have to take a pledge yourself that whether I am clear with the concept of equity beta and debt beta or not. That is the most important thing. If you can't take that pledge, you will not able to understand. So are you clear what is asset beta? Are you clear what is equity beta? Then this question is very simple for you. But just in case again not, then focus again on this. So there are 3 companies which is given. Number 1 is Superior Limited, which has an equity beta of this and this. Second is Admirable Limited, which has an equity beta of 1.3. But it has just taken on a totality unrelated project accounting for 20% of the company's value. That has an asset beta 1.4. Okay. Now in Superior, the equity beta is given beta. Okay. And Admirable may, they are giving you the asset beta. So take the differences of the both. The company is financed by 40% debt and 60% equity. Now there is a third company called Meritorious Limited. The equity beta is 1.05. It is financed by 35% debt and 65% equity. Clear? Tax rate is 35%. If the risk-free return is 10% and expected return of the market is 14%, determine whether the project should be accepted or not. Okay. The company plans debt equity 30/70 for the new project. Okay, beta. So in the first case and the third case, the equity beta is given. In the second case, the asset beta is given. Okay. And all other informations are given. And you have to see whether I have to go for the project or not. But before you proceed, I humbly request you to take the screenshot of this question so that I am in a situation to cover this up, as far as a whiteboard is concerned. Okay. So you are humbly requested to take the screenshot of that. Okay. What we can do is over here, a lot of information is given. Okay. So for the time being, what we can do is we can start calculating at least the equity beta of each company. Okay. I'll do the working on downside. Okay. Over here that you can see the red color. Okay. And I'll start writing over in the top. Okay. Please take the screenshot. I have not given this in the assignment and it's quite important for you to have the understanding. Okay. So number 1. Equity beta is given. So we can have the overall beta. Yes or no? So calculation of overall beta kiske for Superior. Okay. Sir, why overall? Beta, we have to take the average of all of them. So the answer that you will get is the overall. Earlier, the example was I was quoting in which I was giving you the answer, which is the overall beta. You were supposed to calculate the equity. You remember I written the steps. The overall say we calculate cost of equity say we calculate KO say we calculate the value. Here the answer is already given to us that we have been doing. So the formula, we can use the same. Just 1 second. So beta equity into equity by equity plus debt 1 minus tax. Okay. So 1.33 into 50 divided by 50 plus 50, 1 minus 0.35, because the tax rate is 35%. Clear? So can we calculate its answer for sure? 50 ka 0.65, 82.5, 50 by 82.5 into 1.33. 0.806. Has everybody got this answer? Okay. Has everybody got this answer? Okay. So I can write the overall beta here. For superior, it is 0.806. Clear? Yes, sir. Now you would say, sir, the asset beta is already given. So can we take 1.4 here? No. Why? I'll tell you why. Now see very carefully. Admiral Limited has the equity beta of 1.3, but it has just taken on a totally unrelated project. So out of that 100 rupees that they have as a valuation, 20 rupees related to something other than the electronic business. You are getting my point? हम किसकी valuation कर रहे हैं? For which company are we doing the valuation? For an electronic business, right? Yes or no? Admiral, the totality you can see, it says, although it has an equity beta 1.3, but 20% does not relate to electronics. And the one which does not relate to electronics, that has an asset beta of 1.4. So you need to calculate the overall beta for the Admiral Limited. Admirable. Okay, clear? So how do we do the calculation? Just have a very close look, huh? Just have a close look. Okay, so now see, for admirable, okay, the formula remains same. 1.30, this is given already, into 60 by 60 plus 40, 1.35. This is the same step we are doing. Yes, sir. Sir, what is the change? I'll do the change in the next step, because here we don't have that point. Which point? The one which has the totally unrated business. Okay. So what we can do it over here? First calculate. So 40 ka 0.65 plus 60. 86. Okay. So 60 by 86 into 1.3. Okay. I'm getting 9069. So let's write 0.907. Has everybody got this answer? I'm sure you must have been. Okay. Now, what you can do is you can calculate for the only related business. Okay. So I can write over here. So overall beta of A Limited for related business. Can we? So if 907 is the total one, we can do it 0.8 because 20% is unrelated, right? So 80% is related into X plus 20% of 1.4. Getting a point? See very carefully. The overall business, the overall beta kiska of A has two. 80% is related and 20% is unrelated. For this 20%, the beta asset beta is given to us as 1.40. So we have the total 0.907. We have the unrelated asset beta. Can't we get it for the related one? Yes or no? Read the line carefully. Overall beta we have calculated. Simple. Now the thing is that we have to calculate only for the related business. So 80% X, okay? 80% of the X and 20% ka it is given 1.4 because that has the asset beta of 1.4. So can't we get the only for the related business? Definitely, sir. So we can say 1.4 into 20%, yani ki 0.2 minus 0.907 divided by 0.8. So just a calculation, I guess. Okay, has anybody got that? I got 0.78. Okay, so I can write it as 0.78. Clear? So now I can get the value over here. Overall beta for admirable. Only electronics related is 0.78. Two I've got, third one I have to calculate. Clear? So can we do that? Third one. I'll write here meritorious. Okay. M limited. Okay. Equity beta is 1.05. Finance 30% is 65% equity. So again, very, very easy. So not a big problem. So I'm writing without the formula into 65 by 65 plus 35, 1 minus 0.35. So this is simple. 35 into 0.65 plus 65, 87.75. 87.75. 0.778. Clear, beta? Okay. So now nothing much is left. You're almost, the battle is won. So that becomes 0.778. Tino ka aa gaya, we have calculated for all of them. Okay. It says we have to find a proxy beta for the project and on the information on the three companies. So can we take the average of that? Definitely, sir. So average, can we calculate? Plus 0.74 plus 0.806. So this comes to 2.367 divided by 3. So your question will commence with 0.78, the main part. Any doubts still here, beta? This is a question which comes in that exam. So this is the concept of gearing of the beta, Namita. I mean, I'm not done with the question yet. I'm just telling you now because I will have to remove all this. So this is the concept of the gearing of beta, that we value our own company with the information which is related to the company which is into the same business as we are. So we try to do it with that. Okay, everybody has written this value 0.789. Can I rub this entire so that we can proceed with the next one? We have to calculate the for the electronic project. Okay, whether the project is acceptable or not, that is what we are supposed to tell it from the examination one. Okay, so 0.789, remember the figure. Okay, now we can calculate the beta of equity for the इलेक्ट्रॉनिक बिजनेस किसके लिए? फॉर एक्सीलेंट लिमिटेड. ओके, सो द बीटा A is equals to beta of E into E by E plus D. Yes or no? This we've already got 0.789, that is required, into our company's debt by equity कितना है? 30 by 70, and tax is also there. So equity is 70, debt is 30. So 70 by, you can say 70 by 70 plus 30, 1 minus 0.35. Okay, clear? So can we calculate the beta, equity beta? 30 का 0.65 plus 70, okay, into 0.789 divided by 7. Okay, $1.87. Okay, beta, done? Any doubts still here? No doubts? So let's go to the next topic. Namita, this question was asked by our very dear friend Naveen Prakash. So I think I've already answered this. Okay. So now this is okay. Beta of the equity. So can we calculate the cost of equity? Definitely, sir. So what is the RF? 10% plus 1.0087, 14% minus 10%. Okay, so into 4 plus 10. So that comes out to be 14.035%. Okay, cost of debt, where is RF? Okay, 10%, 1 minus 0.35, so 6.5 directly. So can we get the WACC? KO 14.035 into 0.7 plus 6.5 into 0.3. Okay, so into 0.7 memory and 6.5 into 0.3 memory. So that comes out to be 11.78%. Sir, FCFF is not given. Beta, we don't have to give any answer on the value of the business. Okay, we have to do the interpretation from here itself. Has everybody arrived till 11.78? Yes or no? This is in, proximity with the example that I gave. Okay, clear? Concept is clear? So with this, you can now give your answer to the examiner. Sir, what will be the answer? Yes. Now see, the overall, what you're getting is 11.78 cost of capital. And the, where is that? Yeah. And the project is considering that to have a after-tax return of 18%. Okay. So you are getting a return of 18%, whereas the cost of capital is 11%. So should we accept the project or not? You're understanding, beta? The return you're getting is 18%. And to generate that 18%, you are putting the cost of capital at 11.78%, much lower. Okay, so means it's like buying at 20 rupees and selling at 30 rupees, or buying at 5 rupees, selling at 6 rupees. So it's a profit. So how do you conclude over here to the examiner? 11.78 is clear. Okay, so how would you conclude? Because the return from the project is equals to 18%. Cost of capital from the project, okay, is 11.78%, okay, and is much lower than its return. So the project is acceptable since it exceeds our cost of capital. Clear, students? Yes or no? Thank you, Naveen. So nice. Okay, beta. So this was about, I think we have taken about 1 hour on almost one hour, or let's say 70 minutes on this. And I'm sure now it will be very, very easy for you. Because a lot of students I've seen in my life, I'm teaching since so many years, students try to ratify. Study material has done its best. Okay, I would definitely say giving 100 out of 100 on what they have done. But again, if the student is trying to mugify these steps, then I think that's his or her problem. They've given the steps as well, which I've given in my notes, the PPT that you must have seen. So I've given you all those steps over there. And now we are going for 5, 7, 8 minutes break. And post that, we can start with the concept of economic value added. Okay, that is called as the relative valuation method. Okay, beta, clear? So thank you, students. No query means you have understood this concept. Okay, so just in case you are not very sure as to how to proceed further, so the best thing is that you can read the steps from your study material. Okay, now we are taking to the next important concept, which has been coming in the exams for a while, but only clearing the examination is not our only goal. Okay, the other things are also a part. Okay, just wanted to request a few students that there is a very good question, I think, in your study material, question number 4 at the end, back questions. Very beautiful question. So you can take a of that, I mean, concept from there, solve that. Okay, now we are coming to the concept of EVA. Let's start. Economic value added. So as you know, our SFM course is designed in such a manner that BOS doesn't want that you take only the examination approach. You should also understand from the basic real world understanding as well. So before I'll tell you that what does that mean, I'll show you what is conceptually you will be using in the real life, and then how to present in the exam, so that both the things both the purpose get sufficed. Okay, so number 1, what does economic value added means? It is basically means the surplus after providing cost of capital providers. Okay, Now you have just understood the concept of cost of capital, the 11.78 value that you had calculated. Now, you pay to the interest holder, you pay to the government in terms of taxes, you pay to the preference shareholders, and you pay to the equity shareholders. You're paid to the entire one. So after what is remaining, that is required. So there are 3 steps which you need to do it from the examination perspective. Step number 1, the calculation of NOPAT. Okay, the net operating after taxes. Okay, so means EBIT less tax is nothing but your NOPAT. So this is better your step number 1. Okay. Step number 2 basically means that you have to calculate WACC, weighted average cost of capital. Now need not to say what is WACC. Now you are a champion on that. Okay. So just the way you have been calculating in the earlier example, you have to calculate in the very same manner. And step number 3, which is the EVA, which is nothing but NOPAT minus bracket capital employed into WACC. Okay. Oops. Into WACC. Clear, everyone? So should I start with the very good questions which are given in your study? Okay, we can start with that. Okay, chalo, before we start with the directly study questions, let us understand what is the concept. Okay, why should we start with the questions? Let's understand the concept. Okay, let me break this page into 2 parts. Why, sir? I'll tell you. One is that I want to tell you what is it in the real life, okay, and how do you have to show it in the exam so that both the purpose gets fulfilled. Okay, sir. Let me put some examples. Okay, so let's say your equity share capital, okay, is comprised of 50,000 shares and the value is rupees 5 lakh. Simple example. Okay, simple. You have a 12% debt, 12% preference share capital of, let's say, 3 lakh. And you have 10% debt of, let's say, 2 lakh. Simple. Your balance sheet is worth 10 lakh. You have a EBITDA of, let's say, 2 lakh 15,000. Okay. And what all you need? You need a tax rate. Okay. So tax rate is, say, 30%. Okay. Is it visible? So equity share capital is 5 lakh. 12% is your preference share capital. 10% debt is there. So total is 10 lakhs. You have a EBITDA of 2 lakh 15,000 and you have a tax rate of 30%. Okay. And you also have a cost of equity, say 15%. So calculate the EV. Clear, everyone? Nothing tough in this. Okay. So now, how would you proceed this in the examination? Simple. Step number 1, which is calculation of NOPAT, the one which I just wrote. Okay. How do you calculate the NOPAT beta? So EBIT is 215 minus tax at the rate of 30%. Okay, so kitna aega? 215 into 30%. 6 lakh 45. Sorry, it's not 6 lakh. 64,500. 150, 500. Okay. Second step, step number 2, calculation of WACC. Okay. So a lot of items are given to you. That's not a problem. KE, we have KP, cost of preference we have, and KD is what we have with a tax rate. So you can do as 15% into 5 by 10 15 into 5 by 10. What is 5 by 10? 5 lakh divided by 10 lakhs. Okay. Plus 12% into 3 by 12. Yes or no? This is WACC. Okay. The preference share capital can also come to you. Plus debt is 10%. So post tax becomes 10%, 1 minus 30%. That is 7%. Yes. Into 2 by 10. So 15 into 5 by 10. Memory 12 into 3 by 10. Memory 7 into 2 by 10. Memory. So are you getting 12.5, everybody? Yes. And then step number 3, simple. EVA. Okay. So NOPAT minus capital employed into WACC. So what is NOPAT? 150, 500 minus capital employed is 10 lakhs into 12.5%. That is simple. One lakh 25,000. So minus 150, 500. So answer becomes 25500. Okay. This is what you have to show it in the exam. Now, Board of Studies doesn't want that you ratify these steps. You should know what is actually EVA. So this is clear. I mean, examination presentation is clear or not? Because first I explained you the steps. Okay. Now I'm telling you how to do it practically, how to understand that. Is it clear? Yes, sir. Now you see practically over here. What does this basically means? Okay. Calculation of EVA. If you arrive at this step, you will get your full marks. Nothing to worry. But basically, what is it? Better, you know the EBITDA is given to you as 215. Yes or no? Yes, sir. You reduce interest. Yes, sir. How much interest? 10% of 2 lakh, which is 20,000. You will get EBT, which will be, I think, 195. Right? Yes. You will reduce the tax at the rate of 30%. You will get 136,500. Okay. Yes, sir. Pure mathematics till now, minus cost of preference share capital. 3 lakh ka 12%, that is 36,000, minus cost of equity, because we have reduced 3 service provider, cost of capital providers, debt, preference, equity. And after paying all these 3 cost of capital providers, whatever is remaining is called as EVA. And if the EVA is positive, then the company is able to generate some surplus. And the EVA is negative, it would not able to. I mean, it fails to make any surplus. Okay. Cost of equity. Cost of equity. How did I calculate that, beta? 5 lakh ka 15%. Sir, from where did you get 15%? Beta, cost of equity. Okay. The cost of equity, cost of debt, cost of preference. Surplus after paying the equity shareholders. So this comes out to be 75,000 and 25500 EV. So is it same or not? So it's a very simple thing. Study has explained in a very simple manner that after providing all the cost of capital providers, debt, equity, and preference. Debt, equity, preference, whatever is remaining, that is the surplus which the company is able to generate. It's not always the case that EVA will always come positive. It can come negative in the exam, beta. What does this interpretation means? That the company was not able to complete the creates surplus for the shareholders. Okay, capital provided after providing the cost of capital provided. Is it clear? Any doubts still here? No? Then we can move to the assignment. Okay, question number 7 is what, because we have now done question number 1, 2, 3, 4. Fifth, I've given you as homework because it's there. You want to see the answer, it's given your study material. Now we are starting with question number 7, again a masterpiece by Bodo Studies. So I'll you can open up your assignment. I will also show you. Okay. Can I clear this? Okay, 2550. Everybody has matched their figures or not? Okay. Chalo. Now you can open up in your assignment question number 7. Where is the assignment? Yeah. So this is the assignment, question number 7. Let's read it quickly and then we'll start solving this question. Okay. RST Limited. But any doubts, please ask me, because I think today we have our corporate valuation second and the last class. So I think sir would, you would be knowing that we have now another chapter from different sir. So you have any doubts, you can ask me, or sir will be sharing the email ID. I will be sharing the email ID at the last, so you can see it from there. Nothing to worry. Okay. Chalo. So RST Limited's current financial year's income statement reported its net earnings to be after taxes as 25 lakhs. The applicable tax rate is 30%. Calculate the capital structure of RST at the end of the current financial year. You have a debt which has a coupon of 11%, equity as 125, invested capital as 165, means total of both of them. The following data is given to estimate the cost of equity capital, all these things. So thank you. If that is given by the examiner, you need to estimate the WACC and the EV. Now the presentation that I explained you, the step 1, step 2, step 3, please do it that in the exam. Okay. And as far as the real life practical understanding is concerned, I've given you format number 2 in the example, but do not do that in exam, otherwise you will lose marks. Okay. Need not to explain. This you know, I'm sure. Okay. So the net income after tax is 25 lakhs. Okay. So we can start with the question now. Okay. So let's go requirement by requirement. What the examiner has asked. First of all, he's asked us to calculate the WACC. Okay. So let's calculate WACC. Calculation of WACC. Okay. So simple. First, we need the cost of equity. Can we calculate from here? Nothing to worry. 8.5% plus 1.36, and you have answer as 9. The MRP is given. So already said that is excess of return on market portfolio versus risk-free rate. So kind of examiner is being so kind that he's also given you the definition as well. So can we calculate this? Not an issue. So 8.5, sorry, 1.36 into 9 plus 8.5. Okay, so you get this as 20.74. Everybody has got this answer. And the coupon is given to you over here as 11%. So after tax, the cost of debt becomes 11 minus 1 minus 0.3. Okay, so 11 ka 0.7, 7.7, right? So can we do the first examiner's requirement, that is calculation of WACC, which is 20.74 into 125 divided by 165 plus 7.7 into 40 by 165. Okay, so you can calculate that 20.74 to 125 divided by 165, memory 7.7 into 40 divided. Okay, 17.50. Clear? No doubts? So that is the first requirement as far as the thing is concerned. Now we can move to the second requirement. I hope till here it is absolutely clear, no doubt, very simple. Second is calculation of the EVA. Okay, so you can write calculation of EVA. So you have EBITDA or not? Yes or no? No, sir. Why? Because they are giving you net income after taxes. So you can calculate EBITDA. Okay. 25 lakh divided by 1 minus 0.30. Okay. And adding back the interest that you have paid for 40. How do I arrive at this? 40 lakhs ka 11% will be 4,40,000. Okay, I'll get EBIT, EBIT. Is it clear? So 25 lakh divided by 0.7 plus 440. 40,114,28.57. Okay, then you can reduce tax. So 40,114,28.57 minus 30%, you get 280,800, exactly 28,08,000. Okay, so your EVA becomes quite evident. 2,808,000 minus WACC as you calculated 17.50 into your total capital, that is 165 lakhs. Okay, so 165 lakhs ka 17.5%. Okay. Okay, minus 2,808,000. 79,500. Is it clear, guys? No doubts? So you can see that I think EV is coming in negative. Is it so? 165 ka 17.5%, 28.87. Yeah, so that is coming out to be negative. So the company was unable to create any surplus after providing the cost, nurturing it to the cost of capital holders, means debt, equity, and the preference. I'm sure this must be clear. Very simple question and a good masterpiece by the study material. Okay, any doubts, or we can move to the next one, beta? Is it clear? Okay, so we can move to the next one now. Yeah, tender limited, which is exactly after this one. Okay, so the question is, tender limited has earned a net profit of 15 lakhs after tax. Now again, this is also after tax. Interest cost charged by financial institutions was rupees 10 lakh. The invested capital is 95 lakh, out of which 55% is debt. The company maintains a WACC. Oh, thank God. Thank you, examiners. They have already calculated the WACC for us, which is 13%. You need to compute the operating income and therefore compute the EV. Third one is little interesting. It says that the company's outstanding equity shares are 6 lakhs. How much dividend a company pay before the value of the entity starts declining? Sir, what does this mean? I'll tell you what does this mean. So for the time being, the one you can see over here, you can just ignore this. Okay, just ignore this. First, concentrate on both of these things, then you'll be able to understand. Okay, let's start doing this. Again, it's a simple thing, not a very tough thing to understand. Okay, so now beta, the 15 lakhs that you can see is again after tax. You have to make some manipulations in your workings. So let me just start solving it for you. Just 1 second. Yeah. Okay. So PAT is given to you 15 lakhs. Yes or no? Again, this is also after tax. So how can we do that? Can somebody tell me? Now to it's easy, must be easy for you, right? Must be easy for you. So it will be taxes 30%. So EBIT is 15 lakh. Okay, let's do it PBT this time. EBT, okay? Not IT, let's say EBT. Divided by 1 minus 0.30. Okay, so the value that will come out to be that divided by 0.7. So that will be 2142857. Okay, let's ignore the decimal for the time being and add back interest. Oh, the interest cost is given to you. See, last time the percentage was given. So now this time the amount is given. So you can just simply add back the total amount. This is given. Okay, so this is easy, 3142857. Clear? Okay, so next, the computation of the NOPAT. Okay, so 3142857 minus tax at the rate of 30%. Okay, so plus 10 lakhs. Oh wow, it is coming out to be exactly 22 lakhs. So this is a tax amount 942,857. Clear? So, and as a result, you can calculate the EVA. Because all greatness to God that they have given us the WACC. Okay, so NOPAT is 22 lakh minus capital employed is how much beta? Invested capital is 95 lakhs. into WACC, which is 13%. So 95 lakh into 13% minus 22 lakh. Oops, sorry. To 13% minus 22 lakh. So that becomes 965,000. Clear or not, beta? Very easy. Nothing much to understand. Nothing much to get worried, because that's easy concept. Okay. Now you can see this figure is coming out to be positive, right? This figure is coming out to be positive. It means it was able to generate some value, some surplus for the shareholders after providing the cost of capital to the cost of capital owners. Okay, beta? No doubt still here. So if that is also clear, can we move? Okay, can we move to the C point? I'm not saying that I have completed this question. Okay, I told you just ignore point number C and then I'll come back to you. Okay. So you remember this figure, 9,65,000, you remember? Okay, so now what does C says? How much dividend can the company's equity shareholders are, total number of equity shares were 6 lakhs. Okay. So it says how much dividend can the company pay before the value of the entity starts declining. So it is saying, it is asking you nothing but the EVA dividend. Means EVA in totality divided by number of equity shares, and that will be 965,000 divided by 6 lakh. So it says you can pay a dividend of 1.608 per share before the entity's value starts declining. Simple. Okay, clear? That's it. Nothing much is there. Okay, so this is dividend not based on your profits. How do you pay your dividends? From the generatable profits that you have. But again, you don't need to say that how much profit that you earned. You have to just tell that what is the EVA per day. Clear, guys? Simple. Okay. So if that is clear, let's move on to the next concept. Question number 9. So I'm sure you must have read that. Okay. Don't worry. Although it's a big question, but it's not that tough, to be very honest. It's very simple. Okay, so let's start doing this. The company is engaged in a software consultancy. Okay. So the income from consultancy is 965, EBITDA is given, interest on loan is given, tax is given, and as a result, this thing is given, which is the your profit after tax. Okay. This is the balance sheet. All these things are given. With above information and following assumptions, you are required to compute EVA and MVA. Another new concept. Which one? Market value added. We'll cover up this as well. Okay, what are the assumptions that they are asking you to take, beta? They are asking you to take the assumption that WACC, oh, thanks to God, they have calculated our WACC as 12%, and the company is currently quoted at $50 each. Okay, sir. Can we proceed? Yes, sir. Calculation of EVA. Single liner, not a problem. Why? Because you have no PAT. EBIT, that is $180 million minus tax at the rate of, is the tax rate given to you? Yes, 35%. So I hope you don't mind I'm taking a little speed completing questions by question, because this is a very simple concept. And if the examiner gives you some time, so that is like a bonus marks to you, because there are hardly any chance that you will file any technicality. So 117. So EVA you can calculate, beta. So what will be the EVA value? NOPAT minus all this, you remember? So 117 minus, what is the invested capital? Can you tell me clearly? Sir, is it the total? No. This is what I explained you at 9:15, that EVA means the surplus after providing the cost of capital provided. After providing the cost of capital provided. So what all things are there? This, and this. These are the cost of capital providers and not this one. No, these are not the one. They are not providing us any capital. It's just that we have to pay them. Okay. So you will take this beta. 100 plus, sorry. 100 plus 325 plus 180 ka 12%. Why 12? Because WACC is already given to you. Otherwise, you have to calculate. Simple. The examiner will give you some figures to calculate. Obviously, definitely. Okay. So can you do that now? 100 plus 325 plus 180. Uska you can take 12%. That is 72.6 minus 117. So 44.4. Is it positive? Yes, sir. So was they able to provide a positive surplus? Yes, sir. Okay. So that's the answer. EV. Simple. Pretty clear. Okay. No doubt. Okay. So I can say 44.44. I will write it over here. So EVA is equals to your this thing, NOPAT capital employed into WACC. What was the total? 100 plus 180 plus 325, 605. Easy. Okay. Millions dollars. Now the second requirement, what is market value added? This is a new concept. So you can write that properly, that market value added is nothing but market value of equity minus book value of equity. Very simple, very logical as well. How much value did I add in terms of market? Simple. I launched my share at 15 rupees. Now my share value is 25 rupees. So I added 10 rupees to the market value. I bought the share at 15, IPO I have 15 rupees. And now the stock is trading at 24 rupees. So how much value did I add? 9 rupees. Okay. So market value minus the book value. Okay. Sir, how do we know? Thanks to the examiner, they have given us the value. So the market value is, you have 100 as the equity shares total. So it's the 10 million shares of rupees 10 each. So you will write 10 millions into $50 minus the book value. Do you know the value, book value? Price or book value, you must have done the formula in security valuation. So 100 plus 325. The reserve and surplus and the equity share. $75. Clear? This is what the thing is. That is called as the market value added. I hope beta you are understanding the concept of EVA, and I hope I'm not going fast because this is something very simple, and a lot of items are already given by the questions where we might not have to do so much of the hard work. Okay, that's it. Chalo. Last question for the day, last question for this chapter, last question with you as far as my association is concerned. Okay, chalo. Let me clear this and take you to the next question. Yeah. Herbal world. Herbal world is a small but a profitable producer of the beauty cosmetics using the plant aloe vera. Okay, though it's not a high-tech business, yet Herbal's earning has been averaged around 18.5 lakhs after taxes, mainly on the strength of its patent beauty products to remove the pimples. The patent has 9 years to run, and Herbal has been offered 50 lakhs for the patent rights. Herbal's assets include rupees 50 lakhs of property, plant and equipment, and of the working capital. However, the patent. COVID ke baad patient comes in the mind. However, the patent is not shown in the books of Herbal World. 25 lakh ka worth hai. So assuming the Herbal's cost of capital being 14%, you are supposed to calculate the EV. Now the question is not that straightforward that others question you must have seen beta. It is little different. Okay. So this you have to see. How do we proceed? Shall we? Okay. Beta, we are given PAT. No. Yet it is average around 18.5. Okay. PAT. Hit her as average after tax. Okay, the PAT is given to us as 18.5 lakhs. So can we do the working just like we have been doing? Okay, simple. Can you calculate the no PAT? Yes or no? Can we calculate that? Any doubts? Okay. So tax is given. Taxes are not given. WACC is given. Taxes are not given. I think is engaged after tax mainly on account of this. Okay. So again, you can say since the tax is not given in this, either you can assume the tax, okay, or you can say this is the no PAT. Okay, so you can calculate at least the capital employed. So calculation of capital employed. What all capital employed that you have, beta? Number one, you have the property worth 50 lakhs. Then you have working capital, okay, which is worth 25 lakhs. Okay, and they said although you have not taken the patent value, no, patent is 50 lakhs. Sorry, working capital is 50. Sorry, working capital is of 50 and the patent. So even though you have not shown it, you have to show it as this. So 125. Okay. NOPAT, since tax rate is not given. Okay. WACC into capital employed. So 18.5 minus WACC is given to you, beta, 14% into 125. So 125 ka 14%, that is 17.5. So it is able to generate 1 lakh as a positive surplus after providing the cost of capital providers. Okay, beta. So this ends our chapter. Okay, just to give you a 2 minutes revision as to what we have done in this entire content. Okay, in this entire content. And what you need to study from the study material, because it is given so nicely that you don't even need a teacher to do that. Okay, so as far as the corporate valuation is concerned, you should be knowing number one, calculation of value of the firm from both perspective, equity and firm, means FCFE and FCFF. Okay. Number two, that is the gearing of beta. That is important. Okay. Pure play technique is also given in the study material. So nicely given. And the steps is also been mentioned. I've taken it from the study material. Either you can read from the study directly or the PPT which I've shared with you. Number three is the calculation of EVA. Okay, which you already know, NOPAT minus this. Okay, the things to refer. Sorry, not things. Why should I write things? Concepts. Concepts from SM of ICAI prepared by Board of Studies. Number one, the chop shop approach. Very, very simple. There is an example which is given in the study material, excellently framed, and you will be able to do that. Okay. If you want to practice more, there is one question which came in the earlier examination related to chop shop. You can do that. And second is the interest coverage ratio. That is also given the study. Only a simple thing, two-liner question is there. You can, Tiger Limited say there is a question, you can do that. And you want to see if you increase your debt, whether your interest coverage ratio increases or decreases. So again, a very simple question. So you can do this, and this I have covered with you in the last two classes. So I think we should be thanking Board of Studies that we made our association together. And I think sir is also there. I'm not very sure. He'll able to give his, yeah, sir is there. So guys,
Audible, no problem.
Audible.
So when we have covered this topic of valuation. Now in the next class we shall start covering the merger and acquisitions. So, Sushant, please help me to write down. Just share your screen and share the our email ID and our telephone number. You can contact send your email at sfm-final@ici.in. All are in small letters, and our contact number is 0120 3045 956. So 0120 our STD code, and you can send us an email. Okay, students, whatever we have covered in the last two classes, please go through the same and revise your all the questions. Of course, we shall day after tomorrow we shall come out with the topic of merger and acquisition. And till then, have a nice day and stay. I cannot stay at home because somewhere it is a partial lockdown, but because it may be your revision time also. So please revise the same and stay safe. So thanks a lot, Sushant, for your effort in this session. And we shall, of course, approach you whenever we will require your services. Thank you, sir. Have a nice day.
Thank you. Same to you.